What's good, YouTube? It's your boy Charles Enoch. You already know we're back with another Invest in Myself episode. So let's run the intro. So I know I've been out for a couple weeks, but your boy needed a vacation. So I apologize for any comments or emails I haven't replied to just yet. But anyways, so today I want to go over how to pay off your loan, specifically a home improvement loan using your credit card. But before I get into it, you already know your boy has to do the YouTube thing. So I'm just 100 hours shy of being monetized. So I'm gonna ask you guys, help a brother out. So if you haven't done so yet, go ahead, smash that like button, make that thing turn blue. Also, if you're new to the channel or just haven't done so yet, go ahead, take a little time, hit that subscribe button for me. Also leave a comment about the video, letting me know whether you liked the video or you didn't like the video. It helps me for feedback. I really do appreciate anybody that takes the time to do all these things because it does help me reach a higher audience base. All right, so I received a question from a subscriber asking me how to incorporate velocity banking while doing a home improvement loan. So I've done a couple home improvement projects where I've received a home improvement loan, and majority of them do have an option where you can have a 12-month loan, 0% interest. Then after the 12 months is up, the interest rate pretty much skyrockets. So what I pretty much do is get the 12-month 0% interest-free loan, save up as much money as I can within those 12 months. Then I will apply that saved up money towards the loan. After that, I will then use a credit card to pay off the remaining balance of the home improvement loan. Then incorporate velocity banking using the credit card that I just paid off the loan with. Now, I know this may sound confusing, but you already know I got the whiteboard in the back, so we're gonna break it down. So let's get to it. Come on. All right, so we're at the whiteboard. You already know we get straight down into it. So let's look at these numbers here. So we're gonna have an individual, we're gonna say their income is $4,000 a month. Expenses are gonna be $3,500, which is gonna leave them with a cash flow of $500 left over at the end of the month. Now their home improvement loan, we're gonna say it's $10,000. Let's say that they're remodeling a bathroom or something. So the home improvement loan is going to be a 0% interest loan for 12 months. Usually with these loans, the ones that I particularly have gotten, there is no monthly payment until month 13. So from month 1 through 12, there are no payments, but you have to pay it all off before month 13, or else the interest rate will skyrocket and then your monthly payments start. All right, so this individual, they're gonna have a credit card of $8,000, and their credit card is gonna have no balance transfer fee. So a quick thing here. So the credit card that I use is from BECU, Boeing Employee Credit Union. So if a lot of you guys don't know, a lot of credit unions, since they're nonprofit, they will have a credit card that are balanced. The balance transfers are going to be free. So if you don't have a credit card like that, I would suggest that you look into a local credit union so you can get a credit card that is not going to have a balance transfer fee. If you do have a credit card like that, you're still going to be able to do this, but just know that you're going to have to roll in that percentage, and it's usually a 3% fee. All right, so we're on the other side of the board, and we are going to break this down into 11 simple steps in how to pay off this home improvement loan. So let's look at step 1 first. We're going to get the home improvement loan. Again, it's 0% for 12 months, 0% interest. And it's going to be a $10,000 home improvement loan that we got. Again, there are no monthly payments. So number 2, no minimum payment on the loan for 12 months. Now, step number 3, once the project is completed, the loan should start the next month. So this means that you have a minimum of 13 months of cash flow saved up. So let's say that it's January and you got the loan approved in January, but they couldn't start the project until February and they would finish, let's say, mid-February. That means that the loan will be activated in March. So you would have actually 13 months from the month that you applied. All right, so step number 4, the cash flow for this individual is $500. So if we times that by 13 months, we're gonna have $6,500 saved up. Now, step number 5, on month 11, we're gonna use the balance transfer of $3,500. Again, I use a credit union, BECU, so they have no balance transfer fee. And we're trying to use the balance transfer after the statement closes, because what this will do, it will delay the due date back. So we're going to say, for example, they finished the project the end of February. Now, for the credit card, the due date is March 1st. Now, the statement date is March 5th. I would wait till March 6th to complete the balance transfer, because what's going to happen is, since the statement date closed, it's going to say, hey, zero payment is due in April. And once I do the balance transfer fee March 6th, when April comes around and the statement date closes, it's going to say that I owe the $3,500 in May. So it's going to push it out. So we're trying to use the balance transfer after the statement closes. And the reason why we're using it on month 11, you want to make sure that the balance transfer goes through. Sometimes it takes a week or 2 weeks. So you never want to do it in month 12, because you may accrue some interest. So you're always going to do it the month before and then after the statement date closes, to delay the payment, to push the due date back. Now, I do have previous videos that go over the due date and the statement date, what the difference is. So if you're confused, I will attach the link down below. So step number 6, I was just thoroughly explaining this. This will push the due date back when you have to pay back the $3,500. So step 7, month 12, we're going to use the $6,500 of cash flow to pay off the loan in full. Because remember, the balance transfer month 11 was $3,500. We have $6,500 saved up. That will equal $10,000. Loan is paid in full, no interest accrued. All right, so step 8, month 13, we're going to use our income. So the income, we're going to use $3,500 to pay the credit card off in full. And the reason why we're doing that, we had to pull $3,500 from the balance transfer. So that's how much that we owe on the card. So we're going to use, we have $4,000 of income. We're only going to use $3,500. So the card is pretty much paid in full. We avoided any interest on the card because we dumped pretty much our paycheck into the card, onto the card. So step 9, use the leftover cash. So we have $500 left over because we only used $3,500 out of the $4,000 of income. So we're going to use the leftover cash and then the credit card to pay off expenses. So we're going to use the $500 to pay any expenses off. And then after that, we're going to use the credit card to pay the remainder of the expenses. So if we look at it here, the expenses are $3,500. If we use $500 of it, then our expenses are only $3,000. Now our credit card, since we owe $3,500 and we paid it in full, and now we're going to use $3,000 of it to finish our expenses, is going to be left with a remainder of $500 on it. So that is step 10. The cash flow should remain on the card. So the cash flow is $500. Now, step 11, we're going to repeat steps 8 through 11 for 6 more months. So pretty much, since the 500 is staying there every single month, if we do 500 times the 6, we get $3,500. So you're going to repeat steps again, 8 through 11, all the time for 6 months. So you're pretty much putting your full income, as much as you can, on the credit card every single month before the due date, paying it all the way off. You're going to use your remainder cash that you have to pay for expenses, and then after you use all your cash, you're going to use your credit card to pay off the other expenses. You are always going to be left $500 extra as cash flow every single month, because that's what your cash flow is. Income $4,000, expenses $3,500. So this is 11 simple steps on how you can get a home improvement loan and pay 0% interest. So we're first getting those loans that are allowing us 12 months of 0% interest, and there's no minimum payments until month 13. We're going to save up as much money as we have based on our cash flow for those 12 months to put a chunk into the home improvement loan. And then after that, we're going to use our credit card and we're going to do a balance transfer to finish paying off the loan before month 13, before it accrues interest. After that, we're going to be putting our money onto the credit card to pay it off in full. And then whatever cash that we have, we'll pay our expenses. Whatever's remaining off of the expenses, we're going to use our credit card to pay. So I really hope this was helpful. If it was, go ahead, smash that like button for me. If you have not done so, please remember to subscribe to the channel, and please leave a comment if this was helpful, if it wasn't helpful. And if you have any questions, definitely leave in the comment section. And like always, you guys have a good weekend. Peace out.